This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had $77 billion of assets under management.
I have a quote that I keep on my wall on our whiteboard in my office that I've never erased. And I think it hits on a lot of the things that we discussed today. It's from Churchill. It's success is not final. Failure is not finite. It's the strength to continue that counts. And I think that really speaks to venture because you think that success is final when you have a business that's valued above $1 billion. I've seen plenty of them evaporate and go to zero. Failure is also not finite to what we just discussed because you have founders that make mistakes but do it with high integrity and in the right way. And those are the people you want to back again. And so maybe it started with failure. It shouldn't end with failure. And the strength to continue that counts. I mean, that's all around the blue collar work ethic, what we embrace, what we love, what we want our organization to stand for. And so that quote always holds a special place in my heart.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Hunter Somerville, a partner at Stepstone Group, where he focuses on venture capital investing with a particular specialty in micro venture capital as well as venture capital secondaries. Welcome, Hunter. Thanks for joining me today.
Thanks so much for having me. Excited to talk with you.
Well, I'd love to start with a bit of your background. Can you tell us where you grew up, what you studied, and how you came to enter the world of investing from your initial start as a paralegal?
I'm from Baltimore, Maryland originally. That's actually where I am still based. Live about 15 minutes from my parents and my original childhood home. So nice to still be in close proximity to family. And one of my partners at Stepstone, I've actually known since I was 6. So John Avery, who is my partner, we played Little League Baseball together in Baltimore and now get to do what we do on a day-to-day basis as partners within the venture growth group at Stepstone. So pretty cool story. In terms of me, I went to a high school in Baltimore called Gilman. I then went to University of Pennsylvania from there. I wasn't sure what I wanted to do. I've always been drawn towards assessing people and thought I was going to go into psychology at University of Pennsylvania. Ended up sort of pivoting and still not sure around what I wanted to do. Did some stuff in legal studies there and history and economics, and came out of Penn a little bit unsure of my direction. I ended up thinking that I would go in the direction of doing something in legal and got a position as a paralegal for about a year right out of college, just to make sure if I was going to spend as much money as it requires to go to law school, that I'd actually like what I was doing at the completion of that. Maybe to no one's surprise, I hated it and decided not to go in that direction and got my MBA because I realized despite going to University of Pennsylvania, I had actually not taken any finance or accounting classes, which is sort of important, and needed to round that out and decided to get my MBA at the University of Maryland, stayed in Baltimore while I was doing that, and got to make the very pleasant hour-and-a-half drive every day to College Park, fighting traffic to complete a full-time MBA to round out my knowledge and expertise. While I was doing the MBA, I got a job at a place called Camden Partners as an intern. They did growth equity investing. They had a hedge fund at one point, and then they also had a fund of funds product. And the fund of funds product was focused on buyout, a little bit in venture, mezzanine, royalties, et cetera. And it was an incredible sort of window into private investing. I never knew that was an area I would want to go into or that I would end up making my career around. It just seemed like an interesting internship, and I ended up loving it. I joined Camden full time after the completion of my MBA and became an associate there. And back to John Averett, stayed in touch with him, and he joined Greenspring as an analyst, sort of coming right out of his undergrad. And we would share notes on venture capital and the asset class. And I only got some exposure at Camden. He was doing that exclusively, and he convinced me to move over and join in about 2011. I became an associate at that point for Greenspring and have deep appreciation for every role at what was then Greenspring, because I've done everything from the bottom to the top, similar to what John Averett has done. And so the two of us now are two partners on the team, two of the leaders. And about 3.5, 4 years ago, we joined Stepstone and combined with them to form an even bigger and I think broader vision around how to prosecute venture capital and growth equity together, which we're doing to this day. So that at a high level is a summary of my background.
Well, great. Well, I'd love to dig in a little bit to what that high level is. But before that, I just want to go back to something you said at the beginning, which was around your interest in people, the psychology side. And obviously now when you're selecting venture capital investors to back, I presume that person and that analysis of the person and their motivations and their staying power is a big part of that. How do you think that interest in people and now what you do today, how much of it is about analyzing people?
A lot. That couldn't be exclusively how you assess companies. And thankfully, we have people as part of our team that go very deep quantitatively and go into tons of detail around retention and cohort analysis and everything else. That has never been my specialty or where I think I had the most value. I sort of wanted to do a part of finance where it was more driven by the assessment of people than by numbers. And so venture was a perfect fit for that. You're effectively assessing people with incredible vision around what the future will look like and whether you believe that they can execute, prosecute that, recruit a great team, build something great, go through trials and travails and deal with the ups and downs of an asset class that has binary characteristics. And more than anything, you have to find people that you can trust where the alignment is sort of paramount. And I think I'm very good at doing that. And that's perhaps why I've gravitated towards the micro VC category within venture, where we're backing first-time funds or second-time funds at the very beginning of their journey, where we want to be sure that they love this, that this is the only thing that they want to do, that they are going to give 110% and work their asses off to succeed and be able to deal with all of the trials that come by being involved in this asset class. And that really resonates with me when it comes to the assessment side of things.
And speaking of trials and travails, I'd love if you could paint a picture of the venture capital landscape today. I think we've seen quite a bit of ebbing and flowing in terms of interest. I've heard about capital being starved. I've heard about time being starved and not always at the same time. And where would you sort of assess the state as we are today? New administration starting in a few days, pretty interesting tailwind of strong but concentrated equity markets, and maybe an IPO market that's improving and a fairly ebullient private capital industry.
Yeah, I mean, when you do venture, you realize things can change very quickly, even within a month. I think when we first started talking, extremely different than where we are now. And no one even really knows what 2025 will look like. The biggest problem in venture over the past 3 years has been liquidity. You have not had a way to generate liquidity. The IPO window has been, for the most part, closed. M&A has been much heavier regulated and scrutinized. And those are the avenues where you can generate liquidity in venture. For public companies, the scale required to go out has gotten even more significant. It's not 100 million, it's like 300 to 400 million of top line. End of view, or you have to be profitable when you go out, and the growth rates still need to be higher. And so that's a lot of boxes to check. And it's led to a situation where companies have chosen to not go public or go in that direction. And what has become more of a generator of liquidity has been selling into secondary, selling into growth equity rounds, or finding less traditional ways to generate that liquidity. Most people believe that in 25 and 26, the IPO window will become more open. More companies will choose to go in that direction. Antitrust regulation on M&A, we will see what happens there. But I think there's reasons for hope when it comes to liquidity, which have not necessarily been there in the past 2 to 3 years. So that is probably the biggest knock on venture, and rightfully so. It takes longer for companies to get to that scale. And therefore, as an investor in the asset class, you have to have tremendous patience. It's not a transactional asset class. You can't get in and out as quickly as you would like. And so liquidity needs to be there from time to time. We always expect cyclicality to that, but it has been a more challenged few years. On a go-forward basis, I also think we're in an incredible innovation cycle. I'm not going to talk for 15 minutes on AI like everyone else does, but obviously that's a huge driver. Defense tech, areas around deep tech generally defined. I think what's exciting again is people are embracing big swing innovation, which has not been the case, I think, in the past 5 years. It's been more about incrementalism and doing the fifth or sixth vertical software company in the same category. And now people are actually embracing investing again behind innovation that can tackle big problems. And I think that's exciting. That's what venture is supposed to be. I think we've gotten away from that. And I think there's a lot of drivers and capital and support and reason to believe that we can tackle big problems in defense and in energy and in other categories that are really important to the success of our country on a go-forward basis. And so that gets me really excited about the next cycle we're entering into.
I love that term, big swing innovation. It seems so exciting in terms of the opportunity set. Could you talk in broad terms about some of the areas of innovation that you think we're poised to see some change in?
Yeah, like AI will have an impact across everything, but I'm excited that people are looking at ways to tackle climate and energy and defense and aerospace, and that these aren't capital-starved areas like they have been for a while. I think people looked at businesses in all of those places and felt like there were hardware elements or things that were too challenging to put money behind. And now you're seeing a change in the tone around that and real interest in the categories. And I think that that's so important. These can have real impact for our country on a go-forward basis and are areas that need to be tackled and challenged, and capital needs to go into solving those problems. And the private side and venture is the best suited way to really be able to do that. And so I think you're finally seeing a change in sentiment around the people allocating that capital to do more and to really feel like this is a good time to be investing there. And that is different than what we've seen over the past 5 years. So it gives me a lot of enthusiasm.
Before we dig in a little more into the secondary and co-investment aspects of venture, I'd love to if you could take the lens back a bit from a global perspective. Some of these factors you mentioned, the emphasis on innovation, the capital that's available, the IPO market opening, some of that may be US specific. Have you seen venture markets emerge that look similarly stacked in terms of the opportunity set? And I think the other part as well is the ecosystem that the US has long built around that, whether it's around the nurturing of this venture capital company through proactive director roles, an ecosystem that is spawning innovation that may not exist in the same way, or with more regulation, perhaps it may exist in other countries. What do you see in a global landscape?
Yeah, I think there's reasons to be excited globally, but right now we are probably as focused as ever on the US. We have offices globally as part of Stepstone. We've invested globally throughout our history. I mean, if I had to pick a second geography that we're excited about right now, I'd say probably India. I think there's a lot of tailwinds behind India, and we've been involved in the geography for over a decade at this point, both in investing in funds and in companies. So we're excited about what we see there. I think for any international ecosystem, you need ways to generate liquidity. They have a very robust ability to go public, and I think a very supportive market for doing that. In other areas, you just have increased risks you have to contend with. In Latin, South America, currency continues to be a problem with the movements that you see there. In Europe, I think there are interesting areas to spend time in there. Most of the funds are still on the smaller end in Europe, and I think there's a need for more growth capital outside of just from the US players to support late stage and mid stage. Israel continues to be an incredible place for innovation and entrepreneurship. And so, we've been active there as well. So we have a global lens, but we're probably leaning even more into the US right now.
I think just have a word on the secondary market, because I think we know that the secondary market and the mainstream private equity stakes is changing to be somewhat GP led, getting quite deep in terms of just the involvement and the area that represents as a way of mitigating the J curve. How does the venture secondary market compare, and also in terms of discounts?
in venture secondaries, people get way too focused on whether it's like the right time to play that category. We don't think there is as much cyclicality to venture secondary as there is to other categories, but that may also be because we do three different types of venture secondaries. So at certain points in time, one of those could be more robust than the other. The three that we are active in are company secondaries, LP interest purchases, and then what we call GP strategic solutions, which would be the tender offers, the continuation vehicles, the strip sales. Company secondaries, as you can imagine, are scenarios where employees, departed employees, angel investors, seed investors, whoever has been in a company probably for like 6 to 10 years, goes out and seeks liquidity for part of their position. And that makes sense. You can't expect those investors or those employees to wait until an IPO to sell anything. They need to be able to live their lives, buy a house, do whatever they need to do, prove to their spouse this business is real and is actually worth something. And so they will seek liquidity. The company will have to approve it. They'll have to figure out who the best buyer is, who they want to let into their cap table, and they'll allow for that. And so I think direct secondaries generally are a consistent category where there is always a robust amount of volume, because until companies can go public at 80 to 100 million of top line again, there's going to be a need for it. And I don't think it matters the timing as much around that. The pricing may, but there's always a lot of volume and supply. On the GP strategic solutions, there has been a massive push from the LP community for GPs to prove DPI. That has not gone away. People may be more optimistic, as we discussed up front, around there being ways to generate DPI, but DPI is a laggard indicator right now to TVPI, and that needs to be solved because GPs are still deploying a lot of money and coming back reasonably quickly. And so they are increasingly realizing that doing a strip sale, doing a continuation vehicle, generating partial liquidity for their investors is important and something that they need to be thinking about and being strategic around. And so that is becoming a much more actionable category in venture than it ever has been. LP interest has the most cyclicality. You're going to see people selling when they have denominator effect, when they're over allocated, and when they need flexibility to do what they need to do within their program. And so that moves up and down, more driven by macro market forces than I would say the other two.
And just for any novices on venture capital, I'm just going to break apart some of the jargon, the abbreviations you use there. DPI, distributions to paid in capital, and then TVPI, total value to paid in capital. So clearly, it's very interesting, that focus on distribution. So it's kind of a show me the money, even in something that is as long dated as venture and is not necessarily as close to the private debt, very income centric type of investment. When it comes to co-investments, then clearly this is something that's getting a lot of attention from sophisticated investors, perceived as a way to perhaps lower the overall fee load, to load into particularly attractive deals. How much of that are you doing, and anything that's changed about that landscape recently?
Yeah, we've done direct investing / co-investing. I think our approach we view less as a co-investment approach and more as a direct investment approach. But for the broader industry that is doing it in more of a co-investment way, it can be a great way to lower fees and to get that granularity on how managers work. But I would say proceed with a lot of caution. It is not an easy thing to do. There is a lot that goes into it. If you have a tiny team, doing it may not be the best idea. I mean, we have over 80 people on our investment team, and so it's a much different setup than other folks. And when we do direct and co-investing, we are actually proactively tracking the companies that we want to get into. So it is not a reactive motion. We're not sitting here and hoping that our phone rings with a great opportunity a manager is sending us. We are identifying what we think are the marquee assets within the seed and Series A managers that we back. And then we are trying to find ways into those businesses through warm introductions from our managers and through proactively helping those companies through customer introductions where we actually prove our value up front. I think when you take a fully reactive approach, what you end up with are SPVs that are burdened with high level of fees, where you might not be accomplishing what you thought you were in lowering the fees. And you're probably getting very expensive, very late stage exposure that's more banded in return profile. Because a lot of these managers have growth funds, ways to invest in these companies. And if they're now syndicating it at the very end, there may be a reason for that. It might not hit their 3 to 5x return threshold for their growth strategies. And it feels like more of a quick 2x kind of opportunity. And you can find 2x in buyout in other areas. And so you better be sure that that downside is protected if that's what the cap on the upside is looking like. Beyond that, there is complexity in this asset class. Just because you've gotten to a Series Z doesn't mean that this business is going to not have the ability to go to zero and or require 2 more rounds where you should have reserves for those companies and the ability to participate. And if they do a down round or an extension and you don't have the money to put more in, you're getting diluted and your return is going down. And these are just not things people are thinking of when they're coming in to co-investments. And so I feel like a lot of people are thinking this is all a cherry on top, and they're going to get crushed by some of the stuff that they did in the past 3 to 4 years.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him if he could give us a snapshot of the current state of the private credit industry.
Definitely a maturing market would be the first thing I would say. Private credit assets in general are held in very stable or sticky hands. Anytime you hear multiple trillions of dollars in something new, you've got to ask the question, and that's a very fair question to ask. Often what makes bubbles burst is when they're held in short-term hands or unstable hands. And even if my prediction is right that perhaps there will be some defaults in the private credit world, I still think most investors will have a positive return, but maybe not as positive as they were expecting.
And now back to the show. Another key area of focus is the democratization of alternatives and the use of these alternatives for high net worth investors. And venture perhaps has had less of that development than other more mainstream private asset classes. But how do you think about suitability there, time horizon, volatility tolerance, etc., and how much of this democratization and fragmentation, tokenization even, of venture have you seen?
I think you're seeing a big increase in doing that. But for high net worths, like if they're going to play in this category, they need to do it in a diversified format. There's nothing worse than if you're a high net worth and you do one fund that does only a handful of investments, or you're doing direct investments in companies you hear about while you're playing golf with your friends, and you approach it that way. Like venture has a higher risk threshold, and it's an area you should want exposure in my opinion, but in a diversified kind of format where you're getting it across a number of different companies or managers, and how you construct that and how you get that exposure. I think there's different ways to consider doing so. Could be through a fund of funds, could be through a secondary vehicle, but it's not an area where I think people should be doing a handful of directs or one fund and feeling like that accomplishes what they're looking for. Democratization of the asset class is something we've always believed in as an organization, going back to our founder, Ashton Newhall. It's always been an area he's been passionate around. And I do think it's important because if you're only getting tech exposure once it goes public, I think that's unfortunate. It's important to participate in the innovation economy earlier and to take advantage of that arbitrage, which is more significant, in our opinion, on the private side than ultimately on the public side. And so finding mechanisms that are diversified that can provide that is really important.
I also think it's a fascinating way to get a window into some of that. Use a big swing innovation that you mentioned. You can, from reading a report or just listening into an annual meeting or otherwise, I think it is a great way to really open the window on some of this innovation. And thinking about another kind of democratization, in terms of getting capital into more hands, we're thinking about the venture operators themselves. And we spoke a little bit about micro venture and access to capital. And some of these will be small first-time funds. How much of an improvement are you seeing in just the improved access to capital for some of these smaller operators, whether they be emerging, diverse, or whatever term is put on them? There's still probably a few roadblocks there.
There are definitely still roadblocks there. If you look at fundraising data for venture, a very high majority percentage has gone to the multi-billion-dollar established brands. They make up a very high percentage of overall fundraising dollars in venture. And I think as things became more difficult from a macro standpoint, the folks that have struggled to raise have been the long tail of smaller managers. And to some degree, that's a positive, and in other ways, it's a negative. I mean, there were way too many people that felt like they should be venture capitalists and thought that this was all easy, it was all up and to the right, and that it was just a fun job to have that they do for 10 years. It's not really how it works. Like, there is massive swings in venture. There are good times, there are really bad times. And it's hard, and you need a network that is actually relevant in order to be able to prosecute the best opportunities. Otherwise, you're going to get massive adverse selection or choose poorly, and then you end up with a portfolio that you are married to for 15 years. So this is not something you can come in and out of, and a lot of people, celebrities, people with no background in doing this decided to become venture capitalists. So for those folks that weren't committed to it for the long term, I think we're happy to see some of that cleared out in the category. For others, it's been unfortunate because there are great operators or great people that have spun out of established firms that are aligned, that are hungry, that are better suited doing it under their own outfit instead of a brand that has been around for a long time that may have organizational dysfunction or cultures that have become less healthy as people have been successful over time. And those people you really want to give a shot to. And I think in those scenarios, we love being able to be an anchor check in a fund one or a fund two, and then to introduce them to LPs that we know appreciate this asset class, aren't going anywhere, can assess opportunities that have more complexity. And we make those introductions and we help with fundraisers and we're hands-on and involved. And I would say one caveat there is the spin-out managers that are leaving and have track records and have seniority. They raise very quickly. Like, they have no issue. It's very competitive. It's maybe the hardest area to get access and exposure to. For folks that have maybe a less traditional background, still hard from a fundraising standpoint. So you need good partners that will be there along with the journey, particularly at the beginning.
It's interesting. You mentioned that term married to, and I think the 15-year plus time horizon, I would imagine when a relationship goes bad, just like in real life and real marriages, that can be something that leaves a very bad taste for a very long time. Hence the need to get it right and get the people right at the outset. And we've spoken about this volatility has been really just a backdrop to all of this discussion. I think the market volatility, the fundraising, climate changing. In your own career, whether it be in venture or otherwise, have there been any highs or lows or any lessons learned from the low points?
If you're doing venture right, you have to have lows. And I think it shouldn't create a bad taste in your mouth. You should expect that is going to happen, because if you're not having losses, you're not taking enough risk and you're not backing innovation that makes enough of an impact. And so no VC should ever be an asshole to founders or hard on them, like assuming that they approach things in a respectful and transparent manner. Like, things are not going to go right. Companies are going to go to zero. What matters is that you have a trusted relationship where you know when that's happening and where you're proactively trying to fix it. And if you can't fix it, then you're shutting down companies and you're moving on and trying something else. I mean, that's what the American dream is about, is taking big swings and taking risk. And failure doesn't mean that you're doomed forever. It means that you tried and you should try again with a better business model and a better point of view. And so I think people need to have a healthy kind of point of view around that. I've certainly had companies that have gone to zero and failures in the asset class. And with those that handled it with respect and maturity, like, we've backed repeat founders where that has happened on a second time because they've handled it in that kind of manner. And we know they've learned lessons and they'll probably crush it with the second one, assuming they've internalized that in the right way. And so I have had plenty over my time. I learned from all of them, and I do take it seriously because we're managing money for endowments and foundations and pension funds, and that matters. And the fiduciary responsibility is something that is very serious. But at the same token, it is venture. You need to have losses, and you compensate for them by having big wins on the other end. Loss rates for early stage should still be at like 30 to 50%. For growth, probably closer to 15 to 20. Even in growth, things will not work, and you need to be prepared for that. And so it's making the right decisions, backing the right founders, knowing when it's time to call it quits and think about doing something else. And all of that is a day-to-day occurrence.
And there's a couple of closing questions. A lot of these aspects of, say, transparency, owning mistakes early, building trust, these all get to character. And I just wanted to ask you in your career whether there have been mentors that you have learned some of these traits from or learned how to operate from that maybe have been particularly influential.
Yeah, my first job at Camden, I had an incredible mentor, Catherine Burkett. I'd say one of the trailblazers in the industry. She worked at Duke, she worked at Richmond before Camden. I'd just say an OG when it comes to private investing. And she was an incredible first mentor for me and taught me how to think about doing diligence and building relationships when I was much younger and different than I was now. So I think the world of her and much appreciation for her role in my life. Our founder, Ashton Newhall, back in the Greenspring days, I think what he taught me is just to not settle and to work harder than everyone else. We've always defined our culture around grit and grind and blue collar work ethic. We want to be the most responsive. We want to work the hardest. We never want to be complacent, regardless of how successful we become over time. We always want to have that kind of intensity level and couple it with healthy paranoia. And he always pushed me harder than I thought was possible. And so I like that from him. I probably have taken on some of that myself as I manage folks within our organization, just setting bars that are extremely high. My wife at home constantly pushes me and reminds me that I can be better, which I appreciate. I want a sparring partner. I don't want someone who's ever complacent as a partner in life. And I think she also reminds me around work-life balance and how I can be better as a father as well. And that's important because you get very caught up in the work and how much we love it. But as you get older, health and being a parent and being a great parent is something that becomes really important, I think, as you think about your legacy on this planet. And so sometimes I need a reminder that work can wait. And, I need to shape Jimmy and Peyton, my kids, into great people with intensity and work ethic, but that also just have high levels of integrity. And the last person I would say is John Aver, who I mentioned up front. He's just been an incredible sparring partner for me over the years. People joke that we seem like we're married when they meet us, and we bicker, we fight, we push each other. You want partners that you can fight with all of the time, but still love at the end of the day. I think that's important. A lot of venture organizations I see, they don't like each other. You can tell they don't spend time with each other outside of work. We've always had that culture, like where we spend time with each other outside of work. If you have those kind of bonds, you can actually push people harder when it comes to investment decisions because you're doing it from a good place. So that's always been important to our culture building.
I love that because it is true. The more senior you get, the fewer aspects of feedback you get, the less challenge you get. And if you build that in, I think at a peer level, it is so important not to be into an echo chamber and get that kind of disillusioned state of your own ideas trumping others. I just wanted to ask a question on the grit and grind, because that's so interesting. And I presume you hire for that. You look for that in hiring. Do you think that that's something that tends to, because I think it does. I think that's something that you never lose in your life. I think you either have it or you don't. And I think you generally tend to not lose it. But how do you maintain that, keep it fresh? Is it through setting reach goals and challenging the team?
Three of the things that everyone reads when they get here: Extreme Ownership, Grit by Angela Duckworth. And we have them watch the movie on Hero Dreams of Sushi, just because we also believe in mastery of craft and like doing something as well as you can, even if it is rote and mundane. So those three things like are culture defining for people that we hire up front. The other thing about our organization is everyone has been able to increase their role through being part of the organization from the very beginning. So as I mentioned, John was an analyst, I was an associate, and everyone who's moved up into VP, principal, MD in our organization have almost entirely come from internal promotion and growth. We run things like a meritocracy. People who do great work get promoted faster. There's no set timeline, like it's been 2 years, you get the next role. If you haven't met our expectations, you certainly don't. And if you've exceeded them in a year, we'll promote you. So that's how we think about things and how we operate the organization.
Fantastic. Well, last question, any word of wisdom? I love the reference to grit and some of those sources, and I will put them in the show notes. Anything you can leave us with in terms of a piece of advice you received, a creed or a motto, or even advice for your younger self?
I have a quote that I keep on my wall on our whiteboard in my office that I've never erased. And I think it hits on a lot of the things that we discussed today. It's from Churchill. It's success is not final. Failure is not finite. It's the strength to continue that counts. And I think that really speaks to venture, because you think that success is final when you have a business that's valued above $1 billion. I've seen plenty of them evaporate and go to zero. Failure is also not finite to what we just discussed, because you have founders that make mistakes but do it with high integrity and in the right way. And those are the people you want to back again. And so maybe it started with failure. It shouldn't end with failure. And the strength to continue that counts. I mean, that's all around the blue collar work ethic, what we embrace, what we love, what we want our organization to stand for. And so that quote always holds a special place in my heart.
Fantastic. And I'll add one. If it was easy, everyone will be doing it. So I think that's it. It's not for everyone, but it clearly is. Thank you for demystifying what is perceived as often sometimes an elite and complex asset class. I think you've broken it down beautifully. We've woven the personal aspect with the quantitative aspect and charted a little bit of the long-term nature of this asset class. So thank you so much, Hunter, for coming here and sharing your insights with us.
Oh, thanks for having me. It was a delight. Really enjoyed it.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.